Hey, hello. I'm just, I want to jump on here. Hope you all are doing well. I want to show you some things. Let me just get this right. Let's make sure we're broadcasting. How you all doing? Welcome. Just want to make sure we're broadcasting all the different channels as you can see, and make sure, or you can see all the numbers going on, right? Can you all see that very well? Let me make sure you can see if you're looking on your phone. I guess you have to just expand your phone, right? Let me see real quick. Just want to help you out today as we continue to understand wealth building. This is the US debt clock. For those of you that don't know what that is, that you're watching, so it's the US debt clock. Um, Let me try and see if I could get this a little bit bigger for you. But if not, you could go on that website, usdebtclock.org, and check it out. But I'm going to talk about becoming your own bank, how you become your own bank, how you scale in your own bank, how you can use a conversation, a product that's available. So we're going to understand it. I'm going to go in. So just want you all to see this. Basically, as you can see, let me get this in here real quick. Um, Let me pull it up for you. 1 second, folks. Let's just have this conversation, as you can see. So you can see how much debt the U.S. government has, right? I mean, hopefully I can highlight this, man, because sometimes you can. But if you go on that website, usdebtclock.org, you'll be able to see exactly how much debt the U.S. government currently have, right? Let me see if I could get a pen here. Just bear with me as I figure out this whole stream service that I'm using, and I'll be able to kind of show you some things. It's a little bit different from what I'm used to, but hey, you learn. But listen, let's go ahead and jump right in. Let me go in. So the conversation today is, hey, how you doing? Welcome. The conversation today is on becoming your own bank, right? You hear people talk about that, and you're wondering what do they mean. So let's have that conversation, because I want to make sure you understand how to scale. Stop making the bank rich, right? Because a lot of times the mistake we make is we're making those banks rich, and there's nothing wrong with that. Somebody got to make money, right? So, but I want to make sure that you understand the power of your value of your money, because you work hard for your money. And if you're talking to the wrong financial advisors, they sometimes are working for the government, sometimes they're working for the banks, sometimes they're working for the media, because most people get their financial knowledge from the media, right? And sometimes they get it from the people in their circle. Unfortunately, if you're not thinking outside the box, you're not moving away from everyone else and doing something different, it will be very hard for you to build wealth. And why is that? Well, because you're transferring your wealth away to someone else. Because money does two things. Always remember that. Money does two things. Either you're spending money or saving money, right? Either you're spending it or saving. Always remember that. And every time you spend money, and you don't pay back your future person, that's going to be a problem in the future. I don't care how much money you make. Now, understand this, right? We are in the belief system that we're going to keep making money. But what if we don't? Then what happens? For example, you're an investor, you invest in real estate, right? All right, cool. And you're hoping, because when you investing is speculation. That's why there's a big difference between saving money and investing money. Big, huge difference between saving money and investing. So you need to always understand that. So saving money, let's break that down real quick. You're saving money first so that you could invest second. Now, some people will tell you, well, just invest directly, but you shouldn't ever, you should never do that. You know why? You need to first understand what you're investing in. You need to know the history. You need to understand what's going on with whatever investment you want to get into. Because if you don't understand it, you're going to lose. and you're gonna hate yourself for losing. There's so many people who have done it. Now you're gonna have a few people that win, but guess what? We never hear about the people that lose, right? It's just like when you go to Las Vegas to gamble, right? What happens? You see all the people, the winners, but you see a lot of losers. So, folks, don't be in the losing. Don't be a party of the losers, right? You don't want to lose money. You always want to protect your wealth. You work hard for it. You should be able to protect it. So let's talk about that. Let's go, and I'm going to share another screen real quick. Bring up my tools, because my whole thing here is to empower you to be great. So let's do that. Let's make sure we understand money and understand the flow of money and how money works and all that good stuff, right? So for business owners, let's talk to our business owners today. So our business owners, hope you can see my screen. Let me see. Make sure it's kind of a delay. I'm watching it somewhere else, just making sure the screen is sharing. Okay, cool. It's coming up. So for my business owners, I want to talk to you. I want to help you. All right. And also for my folks that work a job, there ain't nothing wrong with that. Don't let nobody ever make you feel guilty for working a job. All right. Everybody don't have to be an entrepreneur. It's okay. You don't have to. If you takes time, just remember one thing, and that's another video, that's another conversation. Always remember this. Entrepreneurship is great, but now you got to put in the time. You're now the boss. But we'll deal with that next time. But for now, let's talk about this. As you can see my screen, right? You see my screen? This is what I call your personal economic model. So for a lot of my business owners, man, if you understand, see your business is in the yellow, right? This is your business. Sometimes you make a lot of money. Sometimes you lose. You don't make no money. See, businesses are a risk on the risk side. They're an investment. That's something a lot of you miss as business owners. Remember, it's an investment. You are investing in your company. It blows my mind when a business owner does this. This is what most business owners do. They make a profit from their business and they turn around, take it, and invest it in something called a 401k plan for their own business. Come on, dude, what are you doing? You're a business owner. You don't need a 401k as a business owner. What are you doing? Are you looking to retire? I mean, retirement is for the people that have the job. You're going to sell your business. Isn't that the whole idea, to sell your business? See, for you business owner, let me give you a game. And I'm going to prove it with an example. All right. Now, check this out. Think about somebody like a Warren Buffett, Bill Gates, Oprah Winfrey, all the billionaires, all that you know. How old are these guys? Are they retired? See, think about Bill Gates, right? Everybody talks about he started his company from where? In his garage or whatever. And then he got funded or whatever. All the story. You go read his book about his history. His company, Microsoft, right? How old is Bill Gates today? Has he retired? No. He said what? Recently, he just did what? He just took $20 billion, $20 billion, and he donated it to his foundation, that to do good, to continue to do the great things that his foundation has been doing for years, right? My question to you, business owner, where's your foundation? Do you have one? Do you have the right ones? All foundations are not created equal. There's a difference between a public charity and a private family foundation. That's another conversation for those of you that tap into my Have Money Forever course. Have Money Forever. Tap into that course. You're going to get to meet me on the other side. Doesn't cost you that much to tap into that course, but you come into the other side, we're going to share more, talk more, and help you protect your wealth. But let's go ahead and continue here. So most business owners, they start what they call 401k, or the new one now is a solo 401k, right? Basically what you're saying is you're going to take your hard-earned profit and invest in somebody else's company, because a 401k is not an investment. Understand that. It's just a name. It's a garage. It's a parking garage but now you have to pack the investment vehicle inside of it. So what investment vehicle do we use in a 401k? You have mutual funds, you have stocks, right? Because most of you are not even putting, because your company is not publicly traded, so you cannot put your company in a 401k, right? So you have to go now invest in somebody else's company. That's what you do when you invest in stock market. That's what you do when you invest in a mutual fund. You're taking your hard-earned profit and you're giving it to a Bill Gates, Microsoft, because now you're investing in Microsoft stocks, Facebook stock, all these companies. But that now it's a part of your solo 401k. So do you even understand how a qualified plan, which is a 401k, how does it work? Do you know how it works? Let's break it down real quick so that you understand how does a 401k work. So let's look at that. Qualified plans do two things. They defer the tax and the tax calculation. See that? That's crazy, ain't it? So they defer the tax and the tax calculation. See, I say it, you're postponing tax. That's what you're doing. You're postponing the tax. The second thing, the question that you never ask is, what tax bracket will I be in at retirement? Have you asked that question? See, for us business owner, for me, myself, right, as a business owner, I'm not looking at retirement. I'm looking at doing what? Getting to the age when I decide, because when you enjoy what you do, see, like how I love what I'm doing right now. I mean, it's fun. See, I could do this in my style. You could wake me up at 2 a.m. now, go through all this scenario because I love it. I love teaching. I love doing this, and I get paid well for doing what I do, right? So understand that it's fun. When you're in the business that you love, it's not a job. So I call it lifestyle. When I get to my lifestyle. So for me, retirement, there's no such thing as that, because most people retire because they want to travel the world. Well, I'm doing that right now. Why do I have to wait till I'm 80 years old to do that? That don't make any sense, does it? You tell me, does it make sense to you to wait till you're old and you can't even enjoy yourself? No, travel now. If your business, enjoy yourself. But I'm going to show you how to do that and still scale your company while maintaining profit for your business. That's the key. Now let's look at that. So most people don't even they don't answer this question. What tax bracket will you be in? So let's address that real quick. See, in America, I always ask my clients, I say, based on what's going on in the economy today, do you think taxes is going to be lower or higher in the future? Is it going to be lower or higher? Most people, you put in a chat bar for me. Let me see. I'm watching this. Let me see here. I'm checking it out on my phone real quick. Let me see the question, the answer that you're giving me. I hope my volume is low on here so it doesn't disturb. All right. Nope. Yes, we can see it. Awesome. Thanks. No, yeah. Taxes is going to be higher in the future. For sure, it's going to be high. You know why? Because we still got to deal with what they call it, the COVID, the money, all the free money that the government gave out. Somebody got to pay. Remember, the federal government makes money off of taxes, right? Remember what I said earlier, 40% of your income goes to taxes for every dollar you make. You know why? Because they got to take care of a lot of things. I think at least they use it to do great things, but sometimes they use it for, to maybe put wall in. Folks, listen, understand this, right? You got to be in control of your money. Don't give it up to the government. But we're going to talk about that because there's a lot of ways for you to minimize your tax liability. So if we know it's going to be higher in the future, do you want to pay it? Do you want to pay it? No, I bet you don't. You don't want to pay that tax. Now, what deduction will you have when you take the money? Oh, see, this is another part that most people never tell you about. Because your financial advisor said, what? You need to pay your house off before you retire, so you'll be on a lower tax bracket, blah, 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 blah. What do you mean I'm going to be a lower tax bracket? I'm in the lower tax bracket right now, not in the future when the tax is going to be high. Understand this, folks. So let's look at the tax history, right? Let's look at the tax history, how the taxes has been. Do you understand that today the average tax bracket right now is 56.94%. 56, that's the average from 1913 when taxes was introduced to America to today. Guess 56.94. That's crazy, ain't it? So from 1913 to this example here, we got 2022. Listen, folks, that's crazy. So right now, today, if you make over $647,000 in income, W-2 income, your tax bracket is 37%. For those of you that get a W-2 income, when you receive income, you pay income tax. Listen, see, the wealthy gives you the clue and you get upset with them instead of saying to yourself, you know what, let me think about that for a second. What did Warren Buffett say? He said, I'd rather pay the same amount of tax like my secretary. Because his secretary, Warren Buffett, richest guy in the world, right? His secretary pays less taxes than Warren. So if his secretary is paying less taxes than Warren Buffett, and Warren Buffett comes on TV and say, I need to be paying more than her. But why aren't you doing that, Warren? Well, because he doesn't take income. If he takes income, he has to pay income tax. But that's another conversation for another day. There's a whole strategy involved in that. But, you know, business owners tap in. So check this out. So let's remove this real quick. Let me take off this situation because I want to make sure you all understand what goes on. This is federal income tax threshold 1913 to 2022. When taxes was introduced in 1913, the lowest tax rate, if you make $20,000, 1%. See that? Top rate, 500,000, 7%. In fact, you know, let me go back to my graph because my graph is beautiful, right? See how beautiful that graph is? Let's go back to that guy. All right. So check this out. So what are they saying here? Well, each year, as you can see, when it first started, boom, then it went up. Look at the highest one right here, 77% if you make over $1 million in 1918. Then it went back down here in 1929 during the Great Depression. If you make over $100,000, 25% tax bracket. So let's look at all the different events. Stock market crash. Oh, so the stock market crashed back in 1929, folks, right? So think about that for a minute. That means a lot of business went out of business. Folks that have their money, if you're a business owner and you have all your money as a business owner in the stock market and the stock market crash, first of all, you're already struggling with your business because there's a reason why it happened, right? Because of the Great Depression. And then all of a sudden, there's market correction. That's a huge problem. But no problem. We're not going to talk about that right now. Let's go to the next one. Great Depression also happened 1935. $1 million, 63%. Boom. Look at that. Then it went to 5 million in 1941. And look at this. In World War II, because the government needed money for war, they came to the American people and said, listen, if you make over $200,000, look at the tax bracket, 94%, folks, 94. So, you know, I'm not going to kill you with this stuff here. Just going to break it down. But then it went down during Ronald Reagan era. The highest tax bracket was 28%. That's why if you listen closely to these wealthy people, what do they say? During Ronald Reagan era, all the rich people were so excited. The wealthy were so excited. They were so excited. They're like, whoa, we got a huge tax break. We love Ronald Reagan. That's what I was broke there. I didn't know nothing about all this. I was still trying to figure myself out. Because that time, man, you know, it's a long time ago. But check this out. Today, the highest tax bracket is 37%. If you make over $647,000 W-2 income, if you realize what I said, for those of you business owners that pay yourself an income, you're gonna get hit with a huge income tax around that time, and you're gonna start crying. You start crying. You start going to your tax guy, and he has no answer because he keeps telling you, listen, you need to buy more cars. You need to spend more. One of my client business owners said, her tax professional told her, listen, you need to spend more money because her tax bill was $160,000. And she's like, they told her to spend more money and do. I'm like, why? You don't do all that. Get into the class. And she came in the class and, we just showed her some strategies, because there's a difference between a tax expert and a CPA, certified public accountant. It's a big difference. That just does the bookkeeping, and as you grow your wealth, you need to start looking outside the box. But we're not going to beat up on those type of CPAs right now. There's different levels. There's different levels to everything, right? Just understand, as you're growing in wealth, you need to make sure the people that you're aligned, that are helping your finances, also understand your growth. You can't deal with the same person that was helping you at 50 grand. Now you're making 50 mil. You still want the same guy he's still giving you the same $50,000 advice, right? So I get it. I know you want to stay loyal to him, but it's okay. If he's open to learning, he could get into a master class and folks will educate him, teach him, so that he could help you better. So you need somebody open-minded. But check this out. So what happens in a case where the account balance, once you retire, right? You have $1 million. $1 million. You're like, man, I got to retire with $1 million, or whatever the case might be. And the government say, well, you owe us some money. You're like, what? What do you mean by that? We just raise taxes on the rich. Oh, am I part of the rich system? Yeah, you are, because you're a rich person. So the government, IRS share theirs, the IRS theirs, $360,000 off of your $1 million. And then you go home with $640, and you got to pay taxes when you go to the grocery store. You got to pay all this stuff. So folks, the key is, how do I control my money? Got to be in control. You got to be in control of your money. So knowing all this, as a business owner, I don't put no money in none of that. I only use the only money I put in the market. I treat it as if I'm going to Vegas. Money that I know if I lose, I don't, I'm not going to cry about it. But you know what? A lot of you business owners also qualify to be accredited investors. They don't talk about that on social media or on the Fox 5 News or CNN or whatever. What is an accredited investor? That's where you tap in. There's some things you could do that is not talked about. That you can't hear people tell you, that you get double-digit returns because you're an accredited investor. It's a different conversation. A lot of you can qualify for that very simply, but you have to have the right advisor that's open-minded, that's outside the box thinker, that understands it. But before you jump into any of those type of things, because some of them are very risky and some are not, it just depends on which one that you're tapping into. Some are very, very risky and some are not, so we'll get to that. But for now, let's understand this picture here. So as a business owner, I take my money, see, and because as a business owner, the benefit we have as business owners, we have the benefit of spending our money first, paying taxes later. You know why? Because as a business owner, we have to invest in our business. That's called business expenses. And then depending on how your business is structured, that's another conversation. How is your business structured so that you can take advantage of all the tax benefit that comes with your business as a business owner? And I'm not just talking about setting up an S corp or C corp or LLC and all that. You know what an LLC stands for? Large lawsuit coming. Large lawsuit coming. Take that. Again, listen. Tap into my course, right? It's called havemoneyforever.com. Go on that website, register for it, be a part of it. It's not that expensive to be on that course. It's very, very inexpensive. It's like a giveaway. Trust and believe. You appreciate it. But check this out. So as a business owner, you make your money. Now your lifestyle regulator is here. Your lifestyle regulator, what is that? Well, this is where your future lifestyle and your present lifestyle are begging for the money. So for example, as a business owner, let's say you profited income, you have income, business income. So now you have a life to live. You have to pay your mortgage and all this stuff, right? You have 100K coming in. So it goes through this. Let's just say you paid yourself a W-2 income because that's what most of you do. So the IRS is going to take their taxes out. So let's assume you're at a 20% tax bracket, right? So you pay your taxes on there. So now you've given the IRS $20,000. Now, I know you would have said, well, if I put it in my 401k, my solo 401k, I would not have paid taxes. Yeah, you would not have paid taxes on the whole 100K. You would have deferred the tax to the future or postponed the tax. I don't want to postpone the tax because I know what the future holds. And guess what? I want to make sure that I want to use my money now. Let me give it to them. Let's pay the taxes now. I give the IRS their money right now. Let them take their 20K. And I'm just using this as an example because I know the math on 20% of 100,000. I'm not a mathematician. I failed that part in school. That's why we love computers. So check this out. $80,000 left, right? So what do you do with this? This is where your future lifestyle and your present lifestyle get into a boxing match. Your future lifestyle is saying, please save, because your future lifestyle speaks in a low voice. But your present lifestyle is like Mike Tyson. So your present lifestyle, Mike Tyson, is knocking out your future lifestyle. Said, man, listen, give me the money, man. I got to pay this mortgage. I got to buy a car. I got to pay for my children's college. I got to pay for food. I got to do all this. Give me the money. And he takes all the money and it's gone, folks. See, it's gone. Now you have no money. See, it takes a lot of effort and a lot of discipline and a lot of energy to force money off this. You're forcing yourself to save and you finally get it in the savings tank. But unfortunately, how much interest are you earning? 0.01%. You know why? Because the banks don't like a savings account. They hate this. In their balance sheet, it's a liability. They don't want it. But because banks make money off of loaning money out, that's how they make their money. So they pay you a low interest rate, and then they loan you money with your money. They take your money and give it to you to buy a car, and you go buy a car. The bank gives you money, and they put, guess what? They put, first of all, they use your credit and your income to qualify you on the car, while they're charging you 5, 6, 7, 18%, depending on your situation and your credit. If you have bad credit, you pay more. So because of that situation, so many people, what do? They're like, you know what? I'm just going to go ahead and pay cash for that car. I don't want to owe the bank no money. I'm going to pay cash. And they go in their savings account and they deplete it. This is what I call a put and take savings account. Put it in, take it out. We put it in there, we fight hard, and then we take it out. How are you going to ever win in this financial game if you keep putting money in a savings account that's meant to be safe, that's meant to be protected? And because the only savings account you know is the one in your traditional bank, your Bank of America, your Navy Federal, your Wells Fargo, because you love the building, you love your bank teller, you love the bank manager. Remember, they're consumers just like you. They don't know any better. They're just the same consumer, just like you and I. The only difference, they work at the bank. See? So they don't have the same information that you're getting is what they have. The only difference is the bank itself, the entity, is not talking to them because the bank is a business. So the bank can't tell them that we don't like savings account. But they give you the answer based on the interest you have to pay. I mean, that the bank is paying you for loaning you the bank money. See, to bring this to life so that you can really see what's going on in your financial world when it comes to how much money you're really making. Because a lot of people don't understand how much this 0.01% really looks like or what it means, right? They put money in there and they're like, well, I just get it. See, there's accounts that you can put money in, and I use cash value banking. People are like, what is that? Cash value banking. Well, cash value banking allows me to do what? First off, I get a better rate of return, and I'm going to keep it real simple because I want to prove something to every one of you here. Let's say I'm getting 3%, and I'm just using this number, 3%. But understand this, it's better than the bank, right? Because the bank is paying me 0.01%. I don't want to put my money in an account where you only pay me 0.1%, and there's nothing else, no other benefit. I mean, what other benefits your bank giving you? See, what you should have is a checking account to pay your bill. That's it. That's all you need to have. Checking account to pay your bill. That's it, folks. Understanding that. Then you should also put this in an account, but it has to be well designed. That will protect you in case you pass away. Do you know that if you have money in your savings account at your local bank and you die today, that bank have they wouldn't give anything to your children. Nothing. They're gonna wait till a judge says, listen, and release the money. Sometimes the money might sit in probate court for years until a judge makes the decision, right? So understanding that there's certain things you have to do as a business owner. The question to you as a business owner, do you have a trust in place? Do you have a will in place? See, there's a lot of things that we don't have in place that kind of affects our money. But understanding this, I like cash value insurance. Why is that? And a lot of you will probably like, why life insurance? I got to talk about life insurance. I don't want life insurance. My financial advisor told me it's bad, it's this. Why are you listening to those people? Do you know how much banks put in life insurance? Do you know how much? Man, I'll tell you this. I'll use my story because me, at the end of the day, it's all about, I can say what I've done with it, right? I've used cash value insurance to do a lot because I could go to the insurance company and say, listen, man, I need some money. And the insurance company will loan me money to invest. I use my money to invest in real estate and buy properties. I use my money in my insurance when I use it to leverage because the insurance company will loan me money against my cash in my policy. They'll give me the money. I'm still earning the compounding interest on all of the money in my account. And I have a death benefit. Just in case I mess around and pass away, my family will get everything tax-free. And you know why it's even sweeter? Because there's certain things that I've put in place to make sure they get it tax-free. Now, secondly, I buy a property, an investment property. When I sell this property to that guy that wants it, guess what happens? I pay off the insurance company. You see what just happened there? All my cash is back in my account, waiting for the next project. I can also use the money in my insurance policy to go do what? To invest in businesses. I could take money from the insurance company. I say, hey, I want to invest in somebody's business and make some more money. Guess what? Again, I go to the insurance company and they loan me money to invest in a business. See, folks, at the end of the day, all we're trying to say is have control of your money. That's what I'm trying to show you. Control. You know why? Because I don't have to pay taxes on the money that's in this policy. No tax. Why is that? Well, because I paid the taxes already. Remember when I was pumping money in here? I already paid the taxes on it. So that when I put the money in the insurance policy, I don't have to pay taxes. This is what I call a Roth IRA on steroids. A Roth IRA on steroids, or a Roth 401k on steroids. Now, this is not an investment. Don't get me wrong. This is not an investment. When I invested in businesses, or I invest in homes, in properties that I'm going to sell, or I'm going to rent out. I really don't like renting out. I just buy it, and I do different type of real estate. There's different types. So always remember, it's not just flipping properties. I don't have time to be chasing contractors around. I don't have time to be chasing people, because a lot of times, you know, you might say, yeah, you need to a management company. Well, you got to find the right one too, right? That will manage the property for you. And 9 times out of 10, you get the right one or you get the bad one. But here's the deal. Why not invest with proven folks that have proven that they could do certain things, and let them handle all the headache? You know, let them handle all the headache. Don't just jump out there and get in. Everything takes time, but you got to let your money be making money while you're figuring it out. So one thing I always say, in the meantime, as a business owner, how is your credit, your personal credit? How is that? Because when you have good credit and you have money, man, the world is about to open up. So what I teach is this: cash value insurance. Cash value insurance is king. So this guy is king right here. Cash value insurance is king. Credit. Let me remove something here. Let me remove all this so you could see what I'm talking about. Credit. And we're gonna use, let's take away the bank. Let's just put regular bank. Let's use regular bank. So cash value insurance is king. Credit is queen. Credit is queen. Now, they both have to be married. You cannot have good credit and have no money. You know, that don't help you, because you jack up that credit real quick. And yes, you could have money, but that means but if you don't have good credit, what happens? That means every time you're doing what? You're depleting your savings to buy stuff. So I don't like that. So guess what? I'm more of cash value is king, because I need to protect my family just in case something happens while I'm investing. And credit is queen. And when credit is queen, guess what? They both get married. Once they're married, now you make money babies. Money babies, because now the banks will loan you money at a very low interest rate. They'll loan you money at a very low interest rate, so that when you come in, when you go back to your banking institution and you say, you know what, I want to use money to do certain things, guess what the bank will do? They'll give you the money quickly and say, listen, no problem. So let me show you all something real quick, and then we're going to call it a day, because I got to get out of here. So check this out. Remember when we talked about interest rate? There's difference between compounding interest and amortized interest. Compounding interest is making money on top of money. So if you have $30,000 and you're getting a 3%. Remember, I use that 3% rate of return. 3%. That means in 1 year you made $912. Unlike me having money sitting in one of those accounts where you're getting 0.25, $75. See, my thing is this: your money has to be working for you no matter what. Sitting in a bank making 0.25%, and the same bank takes the money and charge a high interest rate, let's just say 7%. Because you know what the bank and the government have an agreement on? The government says to the bank, listen, we give you the right to take somebody's money, because we know you hate them putting money in the bank, but they don't know all that. We know you hate it because it's a liability in your book. So when this person puts $30,000 in your bank account, you're going to loan them 0.25% interest. So we know you hate that. So no problem. We give you the right because we want you to go make money with the money. So take that person's money, that 30,000, and loan it to somebody else. Loan it to Mr. A, loan it to Mr. B, loan it to Mr. C, D, E, and goes on and on and on. And make yourself somebody. You're going to charge Mr. A 7% because of his credit. You could charge Mr. B 8%. You could charge 2%. You could even give away money, whatever. We don't care. If you're charging 7% over 6 years, guess what? That's $6,826 you're going to make. Mr. B is going to pay $511. If it's somebody else, charge him 12%. And he's going to pay more, $12,000 over the same period. You're like, what? Now, check this out, folks. But in the meantime, you're getting 0.25%. But I've never seen people get upset with the bank. You actually walk in there and you're so happy. And you're like, yeah, I'm Mr. Big Shot. Hey, Mr. Big Shot, how are you? Everybody, hey, how you doing? They know my name. And you get out of the bank and you feel proud. You're getting your Mercedes Benz or whatever. You're driving home. You feel, my bank manager knows. I could call my bank manager right now. Dude, of course you could call your bank manager. He'll answer the phone. Give me your money and I'll answer for everything. You could call me 2 a.m. and I'll call you back. Man, are you serious? Come on. But check this out, my friends. What about 3%? Ooh. And when you go borrow money, even if you loan money at a 4% rate, guess what happens? See, the key here is this: control. Whoever controls the money controls everything. Stay in control of your money. Don't give up your wealth because you don't want to pay interest. A lot of times we focus on the wrong things. We focus on the interest that somebody is going to make on the money instead of focusing on how much money you're going to make on your money. Stop counting somebody else's money. See, I don't mind going to the bank. That's why you got to fix your credit so that you don't have to pay high interest. And then secondly, take the loan for the longest term possible. I take loans for the long term. If it's 8 years, I take it. A mortgage, 40-year loan, I do that all day, every day. If I have a mortgage for 50 years, I'll take that quickly, right? You know why? Because a house is just a house to live in. I'm going to use my money and make me more money, and I'll buy properties that I'm going to make more money on and do the things because those are investment. I'd rather take the bank's money, pay a low rate. For example, $300,000 loan. If you get a 30-year loan, guess what? At a 4% rate, look at that. Now, somebody's going to tell you, look at the difference. Let me close this guy out first. Look at the difference, right? The bank gave you the money at a 4% rate, and they said, listen, pay us over time, over 30 years, and just pay us $1,432 a month. Yes, the bank is going to make $215,000 off of the money. Yeah, why wouldn't they make that money? But they didn't make it immediately. They're going to make it little by little for the next 30 years. Now, a lot of people are going to tell you, man, that's a lot of interest rate that you're going to pay the bank. You know what? If the bank was going to give it to me at 40%, 40-year loan, look, I'll take that. Do I care what interest rate I give them? I don't care if I pay them $300,000. Who cares? But that's over 40 years. Let me show you the difference. Now, let's let that sit in there and just watch it real quick. Let it simmer in your mind for a little bit. Understand what's just happening here. Compounding interest. This is $300,000 my money, earning 3% rate of return. I'm not even using high return. You know why I'm not using high return? Because that's you don't get a high return on a compounding interest account. So another quick example. There's a difference between compounding interest and speculative interest. When you invest money, that's speculation. When you're earning money, guaranteed return, that's compounding interest. So in my compounding interest account, I earned $694,000. In addition to my $300,000, I'm still in control of $994,000. So what? The bank got $301,000 in 30 years. I'm only paying them $1,254 a month. Who cares? That's like toilet roll money. If you can afford the house, do not buy the house. If you can't afford, don't buy it. There's no rush. Don't get emotional because you want to buy this dream home. Be patient. Build your wealth first. Opportunities will always come, and when it comes, guess what? You have the money to take advantage of the opportunity when it presents itself. The problem is a lot of people don't have the money to jump into an opportunity. You know why? Because they are broke and they have a lot of debt. So we get that because they have no savings. You know why they're broke? Because they've transferred all their wealth to the bank. Because somebody said, why are you paying this money? You could pay extra, make extra payment. So this person does what? He now starts paying extra $2,254, an extra $1,000. Oh, I'm going to pay off my house quickly in 15 years. Yes, you pay it off in 15 years. Yes, I see. You think the bank is crying and saying, man, we lost money. The banks don't care because they loan the money to 7 to 10 people, folks. They loan the money to different people. They made $97,000. They still made money. All they've done now is they said, wow, this person, you just paid us. We loaned this out because this was a liability to us. All right, who's the next person? Who do we need to give this money to? And they take the money and they loan it out again because the money doesn't sit in the bank. That $1,000 that you were giving extra, guess what? You could have put that in your compounding interest account. Look at the money right there, folks. You would have made $222,000. You would have still have control of $582,000. Remember this, and I'm done. Cost, opportunity cost. What is the opportunity cost on this $1,000 that you gave to the bank? $582,000. Always remember that. The second one is control. When the money goes into your house, when you put it, that make extra payment. Do you have control of the money? No, you can't even access it. You need to get a permission again from the bank. The third C is collateral. Can you use the money inside your house as collateral to go borrow money? Well, you got to get approval. But I could use the cash as collateral. Now, the final one is compounding interest, uninterrupted compounding, which means my money continues to grow while I'm using my money as collateral to go make more money, and I keep winning. All right, folks. This is the key. Just wanted to share this today. Sunday, that's my Sunday gift to you. And so that's all I got. Let me see. I want to start a small. I can't read that stuff. Let me see. What is that? I want to start. Let me see. What's this? Let me get to this guy. All right. Man, folks, listen. I don't even know how this thing works right here. Sorry about that. We're going to figure it out on the next one. Let me see. Somebody asked a good question. Cost control, collateral, yes, and compound interest. That's right. All right, folks, listen, have a great Sunday. Keep making it work. Keep working, doing the right things, and make sure you protect your family. Let's keep making it and building it. Hey, Hey, good news too. We're about to hit 1 million views on the documentary. If you're not tapped into that, check it out. See y'all at the top. I have several questions. Listen, go ahead and do that. Go inbox me on Facebook or Instagram. If you're on Instagram watching this, or if you're on IG or Facebook, just inbox me. I'll send you my calendar. I respond to every message. You're not gonna get my secretary, you're not gonna get my assistant, you're gonna get me. All right. As long as you're serious, you want to make a big difference in your life, I'll help you. No problem. That's why I have a calendar. I book my calendar. You go ahead and book a time and we'll talk. I'll be on there and I'll see you at the top. Let's keep it moving and keep winning. Because when you have money, you got a voice. And nobody can ever take that away from you. Because you need your voice. See how my voice is loud? Because I have money. It makes my voice loud. See y'all at the top. Bye-bye.